Hey guys, Mike here. So a lot to cover here, and obviously another red day in the market, as you can see there. So prices are coming back down, no shocker. If you saw my video on Friday, you know why. And so we're gonna get to a lot of that. I mean, if you just look at this right here, this is the heat map from Friday, and I mean that was I believe it was 1.25 trillion wiped off right there, just from that huge rundown. And then this is today's heat map. What do you notice is green? Well, it's energy, right? And you got a few odds here and there, but mostly techs, red across the board. And energy is about the only thing you got going for you in this one. And when we look at the, S&P right here, you can see obviously that huge red candle was Friday. Today we finally did close up under on the daily. The 100-day moving average, that's never a good sign. We had talked about this before. Momentum's obviously pushing down. We gapped down, made a comeback, closed that gap exactly for the day, so that gap does not exist now. And now we got the 50-day moving average in sight. And something else is bearish. If you go, and I've talked about this before, to the weekly chart, you can see on the RSI down there, it broke below the 50 on Friday, continues below the 50 now, and the reason why it's important because when you move above the 50 on the weekly on the RSI, it's actually bullish, and that's what that whole run up from 2020 to 2021 was. And if you look in January, that's when we broke down below the 50. We did the first move up in March. We did that first, I guess, bear market rally. We moved above the 50, curled right back over, and now you see the exact same thing happening right now. Now, when you look back at the chart, I mean, you can see that pattern up there was like these little cups forming, right? It just comes down, and now the question is, are we going to form another one of those and start heading back down towards the bottom of that channel to fill those other two gaps, or are we going to move up and fill the two gaps above us? And, just looking at what we got for the week ahead, I mean, earnings, nothing's going to move the markets, right? But again, a lot of stuff about us again. You got Best Buy, we buying electronics, Big Lots, more of a discount person. Chewy, how much we spending on the pets. And, Charge Points obviously, was a SPAC stock. It's kind of been all over the place. Got CrowdStrike. And so I think those two are going to be probably big movers either way, up and down. Okta's another one's going to make big moves. Again, not going to move the markets. More consumer spending when it comes to 5 and below. Watch out for them. Everything's like $5, even though I think with inflation, it's not $5 anymore. Then you got a safe bet there in Campbell's, which everybody says buy during recession, right? Because everybody buys Campbell's soup. Hormel, Lululemon's another one. That's another one's probably going to get a big move on it, up or down. We'll have to see. And as far as any of the rest of them, I don't see it. The things to look out for, to me, are going to be mainly Friday. You got a lot of economic data coming out, but Friday's the big one because this is payrolls, the unemployment rate, average hourly earnings. And this is key because the Fed is going to be watching this one like a hawk, because right now we still have a hot labor market. And right here you can see, this is what you don't want to see. This came out the other day. This is U.S. wages and salaries in current dollars. You can see right there to the right. I mean, still going up. And this is what the Fed does not want to see. This is not price stability when you still see wages going up. Again, real wages are still decreasing because of inflation. But right now, we, the employees, still have a lot of power when it comes to negotiating our wages, with there not being enough of us out there to fill these jobs. Which in the comments, if you can figure out where everybody's at, let me know. I don't know where everybody went to, and because nobody seems to want to work, but I still see plenty of companies out there that are trying to hire, and they just can't find the employees, especially in healthcare. I see it a lot as well. I hear about healthcare and other kind of companies. They just can't find enough employees. I don't know where everybody's at on that, which, of course, when you have a shortage of employees, guess what? They're going to have to offer higher wages. That, in turn, goes over to the companies. Now, the company has to raise the price of their service or their goods to kind of offset that, or they're going to start taking a bigger loss on the bottom line. And if they're publicly traded, that's just not going to happen. And so, again, it's just this cycle we're in we just can't break right now. And so, that's why you see markets going down, because the Fed, obviously, I showed you Friday, is put a very stern message out there. The other thing I didn't talk about, which is true, which is something the Fed's trying to break right now, is basically how we look at inflation. Like, as consumers, as citizens here, if we really believe, and this is what Jerome Powell talked about, that inflation is just going to stay high, we're going to shop differently, we're going to act differently. That's why you see consumer sentiment at like record lows, even though wages are like going up to record highs, right? I mean, big time, but still consumer sentiment is in the ground because people, one, believe inflation is going to stay high, because probably also they don't believe in the Fed or the government has the ability to fix it because they've been so bad off and have had it so wrong for so long now. And so he doesn't want that bait into the cake. And so he realizes That's a big thing. That's why another reason they have to bring down inflation, okay? And so that's why I only see the market going down. Look what's happened to yields. And I showed this. I'm going to show you this one and then the one from a week ago and how quickly this has changed. And if you look, now you have more inversions happening now. Look at the 30. It's at 3.24%. Now all of a sudden you got a 6-month inverted with it, the 12-month, the 2-year, and the 5-year now. That was not the case just a week ago when I showed you this right here. You didn't have the 5-year, and I believe the 6-month was not. And look how low the 3-month was, at 2.65%. Well, now it's at 2.85%. And just look at the 3 months, the one you really got to watch, because that one, if that one inverts with the 10-year, it's definitely a recession for sure. At least that's what they say. But look how much the 3-month has increased from 0.06% December 31st, 2021 to where it's at right now, and actually at 2.85%. And by the way, if you get anything out of this, please hit that like and subscribe button for me. I really appreciate it. And this is what the Fed wants to see, though. Remember when the market ran up, that's when you saw yields drop off a cliff, mortgage rates started coming down, interest rates started coming down, right? So it made money cheaper again. And so they do not want to see that kind of stuff. And that's why with this market, to me, I think if we break the 50, we're definitely going to go lower. So it just continues that momentum up because people are turning bearish all of a sudden. The fear and greed index went to fearful just like that. Isn't that amazing? But the market also knows, the market makers and the big boys know, like if we run this market up and crypto starts running back and meme stocks again, the Fed is going to say, okay, I guess obviously our message didn't get through again. And obviously you guys, especially if yields start to drop again, rates start to drop again on the mortgage and stuff, they're going to say, we're just going to be a little more harsh, right? We got to get this job done. Inflation is not going to come down until this happens. And if I didn't make it clear the other day, I know I've said this before, but I'll make sure I make this very clear. The way you get unemployment up is you kill demand for the companies who selling services and products, then they lay you off. Okay, that's how this works. They just don't go out and go, let's lay people off because we might have demand come down. No, when demand drops, you're gone from the company. Okay, so just to make sure I'm clear on that. And the thing to look at here, and this is the year of first, right? First time we've seen so many different things. Well, this could be a year first where this doesn't happen, but understand you have inflation, and then you have your federal funds rates. Well, the federal fund rate has never been able to solve inflation and never not gone above inflation when they're raising them, right? And so this is where we're at now, and you can see we got quite a ways to go. You can see to the right there. And so what's going to happen, of course, is the Fed's fund rate just isn't going to come up, and you're going to have them meet in the middle somewhere. That's what always happens. All right, so you're going to see CPI come down, hopefully, if they do their job correctly and everything. And then, of course, the Fed funds rate, they want to get up to like 3.5%, 4%, wherever they go. And then, of course, CPI should be coming down. So they'll meet in the middle. And so we'll have to see, because what they want to really do is hold it in 2023 as long as possible, right? Just slow the economy down to get unemployment up once demand drops. And then hopefully the core would drop below 4%, and then they may start to decrease it, but they'll hold it there as long as they possibly can because they realize their hands are tied. If we do go into a recession, they need as many bullets in the chambers as they can get. So the higher that rate is, the more they can cut that rate. All right. And the thing we don't know about is starting in September, if the balance sheet does start to roll off like it's supposed to, because supposedly they got a lot of bonds and mortgage-backed securities, rolling off next month. We'll see how that goes because it's been really slow so far. That if that starts to pick up, how does the market handle it? The question and truth is, I don't know how they're going to handle it. Nobody really knows how they're going to handle it, right? And so we'll have to see. In 2018, they didn't handle it very well. And so we're already down quite a bit. So we'll have to see how much more they can handle it and then how much more of, and I'm going to have this in a video tomorrow for you guys, of where we're at in the economic cycle again, and because there was an update on that. And then, is this going to be a recession, or are we just kind of more in just a slowdown contraction phase, and how big is the contraction going to be, right? We're still trying to figure that out. And so to me, we're just going to stay, I'll be surprised, we'll probably drop, but it's going to be this range eventually I believe we're going to get into on these markets, and it's just going to become a trader's market where it's going to be up and down, all over the place. But, we'll have to see. And, the thing that's not helping is stuff like this. This came out this weekend, right? And this is going to affect the really big companies here, like your FANG stocks, stuff like that do a lot of business overseas. But it's like spiraling energy costs forced Belgium companies to shut down. And this came out on the 27th here, on Saturday. And when you look through there, obviously, we're talking about several companies in Belgium have been forced to shut down their production facilities due to high energy prices, meaning thousands of employees are currently temporarily out of a job. Stainless steel producer Aperam is shutting down its production facility due to high energy costs, while fertilizer producer Yara, which is not what you want to see, and Flooring Group also are winding down operations. And you definitely don't want to see fertilizer companies doing this because there's already a shortage on fertilizer. I talked to my brother-in-law who's a farmer, and the whole family's farmers, and they said, yeah, fertilizer is not only very expensive, but there's supposed to be shortages, so that's not what you want to see. But the fact that companies are actually shutting down because of the energy costs, that's just not good, right? I mean, I don't remember when that happened again in my time. I'm sure it happened some point in time. And I know Belgium, I'm sure they don't, obviously buy that many goods or a ton of goods, but if they're doing it, that means it's probably happening in other places as well. And along that supply chain somewhere, it's going to have an effect eventually, right? And you can see right here that when it comes to oil, because understand, and the reason why gas prices came down is because the U.S. government has been using the reserves, right? And I think that continues to October. But if this is true, at this pace, the Strategic Petroleum Oil Reserves, SPR, will be at 0 in 18 months. And you can see the chart right there. And so obviously I don't think that's good. But, my question is, you see oil, right, is holding up pretty good, actually. And if you look, if we're supposed to stop releasing the reserves or putting the reserves on the market in October, like what happens after that? Do prices go back up? Do gas prices go back up? I mean, we can't just like infinity sit there and just keep releasing the reserves, right? And so I think it's supposed to stop in October. And so I don't know if that number is correct or not, but if it is, that's obviously not a good thing. And that's the reason why, one of the big reasons gas prices have been coming down here in America is they've been using those reserves, like millions of barrels every day, just hitting the market, right? And they don't plan on buying them back until like 2024, I believe it is what I saw announced. And so obviously more supply equals less price, supposed to at least here in the country. And so we'll have to see. Hopefully we won't need those reserves for anything more than what we're doing now. But that's another thing to think about. If energy spikes again, which it could, because remember, we hadn't solved the infrastructure. The big oil companies, their CEOs have been very clear about it. They're using the money for stock buybacks and dividends. They ain't worried about trying to produce no more oil. That's the way it is. And then you got the Saudis talking about they may cut back. So it's something we can't do anything about. Governments are pretty much hamstrung. And so we better hope come wintertime they don't do that, because if oil heads back over 100, well, that's going to make some really, really interesting times, right, guys? Again, we'll see, but that's where we're at now. I'll have an update in a video tomorrow about where we're at in this economic cycle, so you kind of get an idea on that. I like to at least understand that, because it kind of tells you where we're going or where we're heading and stuff, and it'll make sense to you. I'll make sure of that. So anyway, here's a quick update for you guys. Hope you liked it. Hit the like and subscribe button if you did, and I'll see you guys later.